Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about the potential tightening in loan standards or lending rules as a result of the Federal Treasurer asking the Council of Financial Regulators, which is a cabinet of all regulators, including APRA, who look after the banks, ASIC, look after financial advisors, amongst a whole bunch of other things, the Corporations Act, and so forth. In any case, what Josh was mostly concerned about is credit growth, and credit growth massively outpacing household income growth. So if we're all borrowing a lot more than what our incomes can support, potentially there's some risks to the economy and risks to the financial services sector. And so Josh is concerned about that and has asked them to sort of look into that. Of course, we all know that property prices have been rising in Australia, and particularly in some locations quite significantly. And there's lots of reasons for that, of course. The increase in home loan lending is one of them. COVID and lockdowns and the inability to travel and spend on other items is another factor. But really, rising home prices isn't something that's unique to Australia. In fact, Knight Frank, which is a global real estate business, put out its Global Home Price Index report last week, and what it does is rank the housing price growth in 56 countries, and Australia ranked 18th highest. So certainly not the highest, and certainly a lot of European countries, the UK, the US, and in fact I think New Zealand was number 2 or 3. So there's a lot of other countries that have had price growth that's well in excess of Australia, but still something to be mindful of. And as I said, one of the biggest causes obviously is demand, but we can see demand really through loan volumes. And certainly higher loan volumes have driven higher property prices. But there's a few charts, in fact, that I reference in this podcast, all of which obviously you can find on in the show notes or the blog on the website. But the chart put together by the ABS shows that most of the increase is in owner-occupiers rather than investors. So that's good because owner-occupiers tend to speculate to a much lesser extent than investors. And it's that sort of speculation you don't want to arise in a market. And the other observation is home loan lending has reduced over the last couple of months. Whether that trend continues, it'll be interesting to see. But essentially, home loan volume started to rise in mid-2020. And really the average volume between December 2020 and August 2021, so over that sort of period of time, the monthly volume of loans to owner-occupiers was 21.7 billion on average. And if you look at the 10-year average prior to mid last year, it's only about 11.6. So it's almost double the volume in terms of home loan lending. And you could make an argument to say, well, that's okay, but maybe what we're doing is making up for a bit of lost time. Maybe volumes were below trend for a period of time. Look, I think that's true to some extent, but doesn't really explain the increase. When you have a look at the number of loans and the value of loans, you can start to draw out what's really driving this. And about 60% of the increase has been driven just because of the increase in the number of borrowers, and about 40% in terms of the increase in the average loan size. And so what I think that tells me is that there's certainly a lot more borrowers. So I'm not seeking to water that observation down. But what it's sort of showing me is that we're getting more people at that top end of the market. And obviously that increases the dollar value of loans because they're borrowing on average maybe 2 or 3 times the average Australian borrows, and that tends to skew the numbers. Of course, it doesn't explain in total what's been happening, because clearly there's a lot more borrowers out there that are seeking to upgrade their family home. So what I wanted to do next was have a look at, how has this increased borrowing impacted household budgets? Because if we're really worried about the spike in lending volume, one of the impacts obviously is, people are borrowing a lot of money, and that's all fine when interest rates are around 2%, but what happens when interest rates rise? And so what I have done is I've charted household liabilities, and then looked at what the RBA has collected in terms of data for mortgage interest rates, and then applied or worked out what the interest bill is, the household interest bill. And that tells me, and that data goes back to 1988, so there's really 3 decades of data there, and it kind of shows me, I guess, the interest rate exposure for Australian households, and it's kind of interesting to look at the amount of debt that we've sort of taken on over that 3-decade period. Probably the most interesting observation is the amount of indebtedness in households, and of course that has an impact. If asset prices are rising and we've got more debt, household balance sheets are stronger, and that's fine. But if asset prices correct, or if interest rates rise, that could cause problems for Australians, of course. But as I said, I think the most interesting observation is that households are far more sensitive to interest rate increases than they were 10, 20, 30 years ago, just because they've got high levels of debt. And so the RBA uses interest rates to manage inflation, keep inflation in line. And so if inflation starts to rise, typically driven by increased consumer demand and consumer spending, one of the things that they can do is dial up the interest rate, which takes more money out of people's pockets, means it cools consumer spending, and therefore reduces the inflationary pressure in the economy. And so I think it's probably entirely possible, if not likely, that interest rates maybe will be permanently below around 6%. We won't see a return to pre-GFC levels when, I recall variable interest rates were getting high 7s, low 8s at a particular time. Because of the level of indebtedness of Australian households, I think it's very, very unlikely we'll ever see interest rates above 6%. Now, that's kind of good for planning perspective. When I do my financial modelling for clients, I use an interest rates of 6.5% as an average interest rate, and just to sort of for a few different reasons, which I won't get into here. But when you're doing your planning, using something around 6 or even 5 to 6%, I think's prudent, as long as you build in buffers that interest rates might be outside of that band for maybe a period of time, but it will only be a relatively short period of time, I would have thought. So the upshot is, when you look at the liabilities in households and the amount that people have borrowed, I think the government is rightly concerned that you don't want to be lending someone 10 times their income. That high level of borrowing compared to income is risky, not only for the individual from a personal financial planning perspective, but if you're doing a lot of that in an economy, that is also creates some financial risk. So the regulator is very clear that it considers a high debt to income ratio as anything above 6 times. So if your family income is, say, $200,000 between you and your spouse in terms of gross annual income, and if you have borrowings more than 6 times $200,000, so that's $1.2 million, the regulator would consider you to be a higher risk borrower. And there's another chart from APRA, which is one of the regulators, that shows that high debt to income ratio lending has increased, and it increased in the June quarter by 2.8%, which is the largest increase on record. So it does show that some lenders, some banks, are lending to people, are lending a lot of money to people, which is kind of surprising in this environment, because I'd still consider credit to be relatively tight. And I think it's this cohort of borrowers that I expect the regulator to target. And they can do so by just simply instructing the banks to say, we want to see you reduce your debt to income ratio lending below 6. And it will just mean that people that are trying to borrow more than 6 times their gross annual income are going to have to jump through a lot of hoops to get it approved. And the chances are that the bank's probably not going to be interested because they would just want to do whatever the regulator, of course, tells them to do. Now, this is all very prudent, of course, because I think, we had an inquiry a couple of weeks ago, and the client had, or the person inquiring, had about a family income of around 200,000, and it had they had about 2.1 million worth of borrowings or something, so over 10 times their income in borrowings. Now we declined to have a conversation with that client because we just felt that that's just too much debt. That's silly. So I think it's prudent to make sure we have the processes in place and the regulation in place to stop people from over borrowing, because some people need to be safe from themselves and their own advisors sometimes, where they're clearly borrowing way too much money, and that's a risk to the economy. But the problem with having these prudential standards or these ratios is they can cause some perverse outcomes. And so one in particular is asset-rich, income-poor borrowers. Now, I wrote a blog and did a podcast a few months ago where I talked about the situation where sophisticated borrowers should be treated differently to unsophisticated borrowers. And in particular, the problem at the moment, or the challenge at the moment, is that the banks will tell you they only lend against income, not against asset base. So that means you can have $20 million of cash in the bank, but if you don't have a job, mainstream banks will just not lend to you because they will say, we can't rely on your asset base to fund loan repayments, which is just nonsensical, of course. Now, the banks blame the regulator, saying, well, that's what the prudential rules tell us to do, is that we've got to prove or demonstrate serviceability from income. Now, whether that's true or whether they're just being ultra-conservative and hiding behind the legislation, because there's an element here of credit managers that are employees don't want to lose their job or put themselves at risk, and that's been the case, I guess, over the last sort of 5 or 6 years, where there's been tightening regulation. It's really filtered down to, the people in the back office actually doing the hard work. And now they're so strict and stringent, people are worried about losing their jobs, that they're just not prepared to move outside of policy or look at things in a different way. So the point I'm attempting to make is that implementing a debt-to-income cap is probably necessary, and it's probably prudent. However, lenders should have the flexibility to work outside of these parameters where it's appropriate. So, for example, consider a situation where, someone might have their family home, an investment property, a big share portfolio, a whole bunch of cash, maybe $500,000 of cash savings, but they only work part-time and earn $20,000 a year because that's all they have to work. In that situation, they would go to the bank, and the bank in this environment would go, no, forget about it. We can't lend you $1 million because that's, a ridiculous multiple of your income. In those situations, banks should be given the flexibility to say, okay, this person's got a significant asset base. We can lend them $1 million because, frankly, the property is going to pay for all the interest bill anyway. And in regards to being or seeking a repayment of the loan, that the client's got more than enough money to be able to do that. And anyone that has got themselves in a position that they've acquired that significant asset base is probably, or has demonstrated they're prudent with managing money. And that really needs to be the approach. But my fear is that the regulator comes and says, okay, here's your debt to income ratio cap, and then a whole bunch of other people inadvertently get caught up in that regulation. Now, one of the other practicalities of a debt-to-income cap being introduced or imposed upon lenders is that I think it will widen the wealth inequality gap, and that's certainly not a good thing. So I think high-income earners will then be in the box seat because they will probably retain all their borrowing power. and everyone else will probably have a reduction in borrowing capacity. So, for example, if you think about a person with a family income or a family unit with a family income of $1 million a year, there's probably no need or desire to borrow, say, $6 million, which is 6 times their income. $6 million is probably going to allow them to buy a family home, invest in property, etc., etc., etc. So if a debt-to-income cap is imposed on very high income earners, it has no impact, whereas lower income earners will be most likely be impacted. They're the ones that might be able to demonstrate that they can, say, borrow 8 times their income. If you consider that that's prudent for them to do so based on a sort of cash flow analysis, make sure they've built in enough buffers, etc., etc. But if that cap is introduced, that means that those people aren't going to afford to buy a home where they really want to live. They're going to have to move further out, and or they might be able to buy the home, but they're locked out of investing in the property market. So I think it just widens the gap between, the people with really high income, which are mostly avoided any negative economic consequences as a result of the COVID lockdown. Higher income people are typically in a stronger position today than they were pre-COVID, and people with lower incomes will be mostly or probably only impacted by a change in lending rules like this. Now, what's the upshot for property values and property prices? Well, I like to focus my commentary only on investment grade property, because that's really what my clients are mostly interested in, rather than if you get sucked into a sort of macroeconomic commentary about all property in Australia, including, regional, etc., you start to generalise and it becomes meaningless. So with respect to investment grade property, investment grade locations, I don't think a debt to income cap is going to have any impact. Now, it might wipe out some borrowers, but there'll be plenty of remaining borrowers that have substantially strong financial positions, high incomes, that won't be impacted by this rule. So I think it's something that needs to occur. That inquiry that I referenced a few minutes ago, where they had 200,000 of family income and 2.1 million of borrowings. That's silly. Something needs to change there. So I think they need to do something. Unfortunately, there'll be collateral damage. People will get caught up in that and further impair their ability to really get ahead financially. And unfortunately, the higher income earners won't have any impact. I don't say unfortunately, I say unfortunately from a wealth inequality perspective only, of course, but really from a property price growth perspective in investment grade locations, I don't think it's going to have any impact. Okay, that's it for me for this week. Until next week, bye for now.